Let's prepare to pay a lot more money in 2022. A portion of this video was sponsored by Titan, but more about them later. In today's video, I want to share with you some truths behind some of the numbers that came out from the Federal Reserve with regards to inflation and the economy, and I want to take those numbers and extrapolate that data and tell you what's going to become a lot more expensive in 2022. So here's the TLDW. Too long, Andrei, I'm not going to watch your videos. 2021 was great, except it kind of wasn't because inflation was so high, but ultimately in the end, it was pretty good. 2022 will be even better, but still more expensive. Yeah, I like that. All right, so did you know that 2021 was one of the best years on record for wage growth? Get this, the average person saw an hourly wage increase of 4.7%, which translates to about $1.46 per hour. That's good. But what's bad is the inflation report that came out from the Fed this week, which showed that inflation numbers for December are at 7%. That is the highest that it's been in the last 40 years since the year 1982. So even though we had a record high wage growth, if you take 4.7% and subtract 7% inflation, the real wage growth number is actually negative 2.3%. So on average, people lost more money from their paycheck than they made. But ultimately, everything is good. Because remember, what's the #1 way we know that this pandemic is officially over? And we have to stop wearing these suffocating masks. I'm just kidding, that's my unofficial metric. But the official one is when people are back to work. And people are back to work. Weekly jobless claims totaled 198,000 for December. That's the lowest that this number has been since the year 1969. So almost the last 52 years, which is really good. The stock market is at a record high, or at least near there. Job openings, record high. Wages, record high. Snoop Dogg, he's talking about NFTs, the metaverse, he's everywhere. Super relevant, record high relevancy is what I meant to say. Also, unemployment is at 3.9%, which is almost right where we were before the pandemic started. Because remember, in February of 2020, there was 152.5 million jobs. But today, we're off only 3.6 million jobs. And that's not because there's not enough jobs to go around, that's because labor participation is lower. But that's a personal choice because people are scared that they might get sick. So I guess we've recovered, but it doesn't feel like we have. Which is interesting because when Papa Powell is looking at this heated economy, he says, how do I cool this down? Inflation doesn't affect all of us in the exact same way at the same time, all the time, everywhere, because it depends on our job and what we're buying. So let me give you that breakdown and I'll show you exactly what's about to become more expensive in 2022. It's super interesting and a little depressing, so let's get right into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay because I want my subscriber count inflated. So here's what's interesting. Fannie Mae just recently made an economic prediction. And I know you might be wondering, who's Fannie Mae? Fannie Mae is not a bank that gives out mortgage loans like a lot of people think. Instead, it's a government-created enterprise that was created to guarantee the funding of mortgage loans through the secondary market. So lots of complicated words. What does that even mean? That means the next time you go to a bank or a credit union and you ask for a loan because you want to buy a house, it's Fannie Mae that guarantees those banks and credit unions that they will buy and invest in your loan. The point is that Fannie Mae knows a lot about the economy and they're making a prediction of what's going to happen. And in the first 3 months of this year, the first quarter, January, February, March, they say that prices will go up by 7%. That means, again, prices will continue to go higher and higher. But then they say at the end of the year, the average inflation number will be something like 3.8%, so lower. But my question is, what exactly is going to become more expensive this year? So here is that list. But first, a quick word from today's sponsor, Titan. So personally, I've always wanted to learn how to invest like the ultra rich, which is why Titan is the world's first investment platform that was designed for everyday investors that want their money actively managed by a group of experts. Their goal is to grow our money by 15% per year, which would imply doubling our money roughly every 5 years or so. My favorite part about the app is that you can actually see exactly how they're managing your money because they give you updates with videos and written updates so you can understand their investment thesis. And here's exactly how it works. You get the app, you put in your profile details, and it gives you a customized portfolio based on your risk tolerance. Now, since this is a sponsored video and I'm a client of Titan's, I put in $10,000 of my own money to see if if they can beat the market for me. Now, you don't have to do $10,000. You can get started with as little as $100, but here's how they split it up for me. 60% is allocated into flagship, which is high quality companies, big names in the S&P 500 that they think will beat the market. This is 15 to 25 handpicked stocks. Another 17.5% is split into opportunities, which is in the small cap sector or smaller companies, 15 to 25 stocks there as well. Another 17.5% into offshore, which is in the emerging markets, another 15 to 25 handpicked stocks, and the rest of the 5% is in crypto, which is 5 to 10 handpicked cryptos that they think will do better. Again, I put in 10 grand. You do not have to do that. You can start with as little as $100, and if you go to titan.com/Andrei, you can get 3 months of investment management for 0 fees. That's titan.com/Andrei, 0 fees for the first 3 months. Thank you, Titan, for sponsoring this portion of the video. Let's get back to what's about to become more expensive. I want to thank Andrew Lisa for putting together a portion of this very comprehensive list, but the first thing that's going up in price are gas prices. Now, there's this app I use called Gas Buddy. They're not sponsoring this video, but if you have a car and you don't have this app, please get it. It's amazing. Tesla owners don't need to apply. But this app shows you the cheapest gas prices that are closest to you. And right now I can see that within a 2-mile radius, there's a 51-cent spread on prices, which is a huge savings. The point is, they know a lot about gas, and they made a prediction for 2022, and they're saying that the average price increase to gas this year will be something like 40 cents per gallon. And by springtime this year, they can easily reach $4 per gallon. That's huge, but I'm really horrible at making sense of all these numbers because I never check them and what they mean until I'm at the gas pump, so I did some math and it's kind of shocking. Right now, the cheapest gas near me is $3.38 a gallon. Our 2017 Toyota Corolla has 13.2 gallons. Multiply those two together and you get something like $45. Now, if you change that to $4 a gallon, then that's $53 to fill up. That's a $9 difference. But since we fill up twice, that's actually $18 a month. That doesn't sound like a lot, but think like an investor for a second. $18 times 12 months is $216 a year. How much money do you need invested in the markets to make $216 while you sleep? If you're investing in dividend stocks like me at a safe target rate of 4% interest or yield, then you would need to take 216 divide by 0.04 and you get $5,400. That is how much money you need invested in the markets, and that's the true cost, the opportunity cost. So keep all of that in mind as I talk about these little increases. Next up on the list is one that hurts me personally, and that is restaurants and fast food. I love fine dining, and there's nothing better than Taco Bell. But for the first time in 25 years, for example, Little Caesars has increased the price of their $5 pizzas by 11% to $5.55. And in order to compensate for that increase, they want to give their customers 33% more pepperonis. So instead of 10, you'll get 13 and a third. Chipotle increased their prices by 4%. That's an average of 30 to 40 cents per meal in order to compensate the $15 an hour minimum wage increase. Also, McDonald's increased their prices by 6%. Dunkin' Donuts increased it by 8%. And Taco Bell, my favorite, did the unthinkable, increasing 10%. Now, in the last 12 months, the unadjusted 12-month inflation for eating away from home is 6%. By the way, unadjusted just means that it hasn't been modified yet to take into account the seasonal adjustments and changes in prices. I hope that makes sense, but still, 6% across the board is relatively high. But here's the most interesting part though, because if a business wants to increase their margins or essentially make more money, they have two options. They can either increase the price of their food, which is obviously not very popular because I don't want to pay more for the same stuff, or they can decrease their serving sizes. And this is a true story because Domino's Pizza, for example, is taking their $7.99 10-wing option from 10 wings down to 8 wings. And this is a very subtle way of dealing with inflation because we are going to pay the exact same amount of money for less stuff. And if I can give you a magic analogy, which makes no sense at all, it would be like this. You take a fan and over time, the illusion is that I'm shrinking the cards down and you're not really noticing it, but over time, the effects are really, really noticeable until I shrink it down to a rosette. This is not inflation, this is shrinkflation, and we're gonna see a lot of that this year. And the ultimate question is, why are things becoming so much more expensive? Some of the reasons is because there was a shortage of certain ingredients like beef and chicken whose prices went way up. Not to mention that food went way up from December 2020 to December 2021, like bacon up 19%, steak 21%, cereal 6%, eggs 11%, and on it goes. Not to mention the fact that there was a shortage of truckers whose incomes went way up. Because if I'm someone who's looking for a job, why would I work in retail at minimum wage when I know I could apply virtually anywhere else and get hired and probably be paid way more? So to stay competitive, these fat food I always want to say fat food places. I mean, technically I'm not wrong, but that's why these fast food places increase the minimum wage to $15 an hour to stay competitive. But if they do that, those costs pass on to consumers. Inflation, it's the snack that smile back. Brought to you by Goldfish. Here's what else is going to become more expensive in 2022. Dollar stores, furniture, and electronics. The Dollar Tree store, for example, said that they would increase their price from $1 to $1.25, which is insane if you think about a company that's been around for 35 years. That's entire brand is based on everything's $1, which now has to change thanks to inflation. That's just nuts. Also, furniture is going to become more expensive. IKEA said they're increasing prices by a whopping average of 9%. And after Christmas, they increased the price of some of their furniture by as much as 50%. Also, TVs are gonna become a lot more expensive this year. I remember way back in 2010, I bought myself a Samsung 52-inch HD TV for like $1,500, an insane amount of money. But nowadays, you can get a 65-inch 4K TV for like $600. It's amazing, but thanks to these inflation in supply chain problems, we have TVs going up by 30% since the summer of 2020, and that's because we can't find silicon, the thing that we use to build microchips with. And that affects all electronics, from TVs to computers to phones to cars and everything in between. So everything I've said so far, though, you can kind of wait to buy maybe later, unless it's food. But the most expensive thing that we're gonna pay for in 2022 is arguably the thing we cannot wait for. And that is loans and assets. The National Association of Realtors asked the top 20 economic experts what they predict is gonna happen this year, and the overwhelming consensus is that Papa Powell is gonna increase the rates by at least 2 times this year, by 0.25% each time, bringing the 30-year mortgage interest average across the US to 3.5%. They also predicted that home values would appreciate by 5.7%, while inflation would go up by 4%, which, if you remember, is very close to what Fannie Mae predicted at 3.8%. Now, my question is, how come if interest rates go up by 0.5% and if home values should theoretically correct by 5%, why are realtors still saying that home values would still increase by 5.7%? Because they're realtors. I'm just kidding, it's not because they're realtors. It's because if prices fall by 5%, you'd have to assume that for them to stay that low, which by the way is a huge correction in real estate, 5% is massive, you'd have to assume there's not gonna be a lot of demand. But the truth is, there's an insane amount of demand for US real estate across the entire world. Everyone wants to invest and buy housing in the US. And so even if we get a huge 5% correction, it's not gonna last a long time, because it feels like everyone I talk to is waiting for this real estate bubble to pop, and that's when they're gonna buy in. But I think if that does happen, those houses will be absorbed very fast. And by extension, I think this will spill over. All of this inflation will reflect in stocks, in crypto, in real estate, and everything in between. And I think asset prices across the board will be worth a lot more at the end of this year than they are at the beginning, which is why I'm leaving all my money invested in the markets. As always, have a wonderful rest of your day. Smash that like button, subscribe if you haven't already. Go grab up to $250 worth of free Bitcoin with this BlockFi link right here, blockfi.com/Andrei. Love you. Thank you so much for watching this video. I'll see you back here on Monday and Friday, sometimes a Wednesday. Bye-bye.